everyone, this is Lisa, and welcome to another edition of Accounting Wise. Today we will be talking about capital and revenue items. At the end of this video, I will expect you to be able to distinguish capital and revenue items, expenditures, and receipts. So let's begin with capital and revenue items. Every business is expected to operate for many years, based on the going concern principle, if you remember. But they are required to prepare the financial report annually or usually 1 year. But some of the businesses report their financial statements based on their accounting cycle, which are shorter than 1 year, like quarterly or semi-annually. In preparing the financial statements, the transactions involved are short-term and long-term. Business entity can spend money on long-term assets such as property, plant, and equipment, a delivery truck, or the land and building. They can also spend money on their day-to-day operations like salaries and wages of employees. They also receive income from their day-to-day operations and from other resources such as bank loans or additional investments from the owners. So let's distinguish capital and revenue items. Capital items are items of long-term nature, like property, plant, and equipment, which are used to carry out the operating activities of the business. The revenue items are of short-term nature that are used or occur in the normal cycle of business operations. So when we say short term, this is usually 1 year or in the normal cycle of the business. So if the normal cycle of the business is 6 months or 3 months, it is short term if it is within that cycle. When we say long term, it is beyond 1 year or beyond the normal cycle of the business operations. So as a rough guide, a capital item goes to the balance sheet or the statement of financial position because of its long-term nature. And revenue items goes to the statement of profit and loss because of their short-term nature. Let us now go to capital and revenue expenditures. Capital expenditures are expenditures to acquire long-term asset for the business. The cost of expenditure to acquire capital expenditures form part of the cost of the asset. So it will be capitalized and is called a capital asset, and it will form part of the balance sheet as non-current asset. So for example, the company bought land and building for a cost of $1 million. The $1 million will form part of the cost of the land and building and will be reported on the balance sheet as non-current asset. It will not be an expense account. On the other hand, the revenue expenditures are expenditures on the daily operations of the business. These are expenses and will be reported on the income statement. So as an example, for example, the business had bank loan for the amount of $1 million, and it has an interest of $10,000. The $1 million is part of a capital asset or a capital expenditure, but the interest expense of $10,000 will form part of the expense account in the income statement. And finally, we have revenue, income, and capital receipts. Capital receipts are from long-term income. This does not affect the financial performance of the business, but it only affects the financial position of the entity. Example of capital receipts are money from loan in a bank or investments from owners. The revenue income are income from the business operations or its investments. Example are interest on in cash in bank or interest on investments. These are reported in the income statement.